Okay, so we're dealing with income tax. So I said whenever they tell you something like the balance and the trial balance, okay, relates to an under over provision, or they give you any information that's very close to that. The other way they usually put it is they'll tell you that they provided for, or they made a provision of say 20M, and they tell you that when we catered for what we had spent, we are left with something. Now once they say something like that, then just know they're saying it's an under or over provision. Chiravo, feel free to. Shakira always. Chiravo, say more. I think you want to say something. Feel free. But otherwise, what I was saying is that for income tax, whenever there's an under over provision, you're supposed to first remove the under or over provision by doing the reverse. Okay, if it's an over, meaning it has a credit balance, debit the provision and credit the income tax. If it's an under, that meaning it has a debit balance, credit the provision and debit income tax. As simple as that. Then if they say now like there is that you have an estimate in income tax, an estimate usually, like I was telling someone about the provision, is that you anticipate you're going to incur an expense, but you don't know how much and when it will occur. So you just make a provision for it with a particular amount that you think will be. Okay. So in that regard, it's what you're supposed to do for income tax here, the estimate. Okay. Therefore, recognize the provision. Since you already have a provision made already in form of a tax payable, you credit your tax payable and debit the income tax expense. That's how you deal with the estimate. Then deferred tax. Deferred tax at this level, I think they mainly said looking for the increase or the decrease in provision for deferred tax. And that one is simple. If it is an increase, meaning that your provision is supposed to increase, so you're going to credit your provision and debit, okay, and debit the expenses, or what you say, you call it increase in provision for deferred tax. But usually it's not a line in the income statement, so we take it under the income tax expense. So it increases the income tax expense. If it was a decrease in provision for deferred tax, meaning that you're going to debit your provision, the credit will affect the expense, which is saying the income tax now. Okay, so if I may take you back to our workings, basically that's what we did really. So if I may take you back to our workings and we pass the entries, we see how these entries are reflecting on in the statements. Okay, otherwise are we supposed to write these things of debit and credit? Okay, in my opinion, I think yes. Okay, because this is where your working is coming from. However, if you think you can find a way of getting figures without doing this, which I doubt really, which I really doubt, but it really depends on you. But these entries are very important, okay, as you're going to see. But now, for example, income tax, there are shortcuts that you can learn, like I'm going to share with you here, how we can learn those. For depreciation, we also know that you only think of, you go under expenses, put the figure there, go under assets, put the figure there. Okay. By doing that, you're debiting and crediting, although you don't know that you're doing it. So even for income tax, I'll share those. Okay. Okay, I'll share those. So if I may share for income tax. So we're saying that this provision here, by doing this, you're removing what was in the trial balance. Okay. So allow me first show the debit and credit. Then I'll show you the shortcuts that you guys prefer using. Okay, so my provision now, we know that this one falls under current liabilities. So you come under current liabilities and you say tax payable or provision for income tax. Then the first thing is, what did you have at the beginning of the year? It's in the trial balance. Okay, so it was 1,000. Okay. Then you ask yourself, what are the entries that you made to this very particular account? So the entries are that first of all you debit it. So when you debit a liability account, it will reduce. So hence minus 1,000. Then what else did you do with that very account? You credited it with 9,000. Hence you add the 9,000. Okay. So that's why in shortcuts they tell you that what you do is you just keep the 9,000 figure for the liability, which is the final estimate. Okay. And then you go to the income statement. Okay, what you're going to do. So the income statement, why you go there is because of this income tax. It's an expense account, so it goes in the P&L. So when you go to the P&L, therefore, okay, when you check, of course, the trial balance, you're not going to find there anything like income tax expense. Okay, keyword is expense. Okay, so because you don't have anything there, you just have an income tax here, income or tax. Let me just call it tax. Okay. It's income tax. Income. It's an expense account. Okay, did you have anything at the beginning? You didn't have. Okay, so but what you have are these entries. Now these entries under income tax is that you have equality to 1,000. No, equality is a minus, so it come last, right? But you have a debit here, income tax of 9,000. So you're saying you get 9,000. Then they're saying you credit. Okay, so credit they're saying you minus 1,000. Okay, and then the change in the deferred tax. Okay, here we also credited it. We credited income tax. So when you credit income tax, it reduces. Yes, minus. Okay, then you close. Okay, so someone will tell you what I've just done. These are the channels that have brought me to these figures. Okay, so just respecting these entries. Okay, now with me, of course, I always have an upper hand because of these entries. But now you who wants to pass the paper, just and move on. Is that you keep in mind that under my income tax, if I have an estimate, I'm going to bring it here. Okay, I'm going to bring it here. Hence the 9,000. Then if I had an under, okay, an over in this case, if I had an over, you're supposed to subtract it from the income tax. Okay, the 1,000. Okay, are we together? Then if you had okay, then if you had a change in deferred tax, you might look at two things. Is it increasing? If it is increasing, then we add here on the income tax. If it is decreasing, then we deduct. As you can see, that is more of I don't know what I can call it. Is it scrum work or what? Okay, not two. There was interest paid of 15,000. Just two. I'll check again, but I didn't see anything like interest. Not two. Then so coming back to my entries. Okay, so I've dealt with income tax and provision for income tax. Okay, I've dealt with this. I've dealt with this. I've dealt with this. Dealt with this. Then deferred tax is remaining. Now deferred tax, it is a provision. So deferred tax will come under still your liabilities. Okay, this is a provision. Then you say deferred tax. Okay, usually it's a long-term liability. Okay, deferred tax. It's a long-term liability, and the reason being is usually arises on non-current assets. Okay, and any changes that may occur in, but mainly think it happens whenever there's a revaluation, whenever there's change in an asset. That's not cash in nature. Okay, usually deferred arises from there. But I think the more detail will be given later. But for now, let me just stick to that. Now, deferred, we said we made a debit or a provision. So, but remember, it had a figure, a trial balance. Okay, that figure was 56,000. All right. So, by the entries that we have done is that this deferred here, the provision was debited, and when you debit a liability, cost has to reduce, hence minus 6,000. That's how we end up having the closing balance of 50 as the only figure under deferred. Okay, so someone will tell you that whenever they change in deferred, what you do is the new balance, you take it straight to the trial balance, the balance sheet. The new balance, the closing balance, take it straight the balance sheet. Then the change, you take it to income tax. Okay. Someone will tell you that that is a shortcut, but I don't know if you have understood anything in what he has said. Okay. But basically that is it. So I'm done with income tax and my. So let me go back to my additional information, especially not 2, which someone was saying that I skipped. Not 2. Okay, not 2 says that sales revenue include for billion for goods sold for cash to Kampala. The cost of these goods is 3 billion. Kampala Bank has an option to require the company to repurchase these goods within 2 months of the year end at their original selling prices, plus a facilitation fee of 125. So I'm not seeing any interest here, unless someone is saying that facilitation fee is an interest. Okay, but if it is, we already recognize it as an expense. Okay, so let me continue with our thingy. Okay, so after income tax, now there's another line which says it has been discovered that the previous financial controller of Pasiola engaged in fraudulent financing reporting. Okay, currently 250 billion of trade receivables has been deemed to not exist and requires to be written off. Okay, of this, they're saying 90 million relates to the year ended 31st March 2019, so the current year, and with the 160 relating to the earlier periods. Okay, now I feel like I'm doing this. The reason is because we have not covered it in class. Okay, this is IAS8. Okay, changes in accounting policies and accounting estimates. Okay, I also think it is IAS 10, events after the reporting dates. Okay, so we didn't cover standards in class, but idea in this thing, in this step, you allow me to just skip it for purposes of the class since you can't set it. Okay, and I'm sure most of you are reading for coursework, so let me not put you into that. So I haven't covered this standard. Okay, but otherwise, what would happen is that you'd have to reduce your receivables with a 250. Okay, the receivables must reduce with 250 because that money doesn't exist. Hence writing off. Then you go under P&L and you show that either bad debt is enough or you say money stolen. Okay, as long as you recognize an expense. Okay, but in the P&L, you don't recognize an expense of 250 entirely. No, you only recognize the expense that belongs to the period, which is 90 million. Then the balance, you go under retained earnings, under statement of changes in equity, and reduce it, the 960, and remove it from there. Okay, so that's a treatment, but let's not give it for now, since we haven't covered the standard. Let's go to note 6. They're saying that the non-current asset investment are to be revalued by 600. Okay, so non-current assets are to be revalued by. So I think this is an increase. Revalued by, it's an increase. So of course this is investment. So this is IAS40 investment. So increase in value. So now the challenge with IAS40 here, they didn't tell us whether this is a fair value model or revaluation model. Okay, there's no revaluation model in IAS16. There's cost model and fair value model. So changes in if it was a cost model, the change would go to the OCI. But if it is fair value model, the change would go to the P&L. Okay, so let's look at the asset in the trial balance and see how much it was. Then we go to our workings. It is here, non-current asset investment. It is 1680. Okay, so we got our workings. Working, I'm going to call it working 6. It's IAS40 investment property. Okay, the balance brought down, or the opening balance, is 1680. Okay, but they're saying there's a revaluation gain or a gain in fair value of 600,000. So our new balance is, okay, so this is what someone wants to see. Wants to see that you go and add and do what and do what. But the truth is, these are entries. Because this gain here wasn't there in the beginning. Okay, and therefore you're supposed to debit the asset. Debit the asset or the investment property with the 600,000. Then you credit. So the credit here depends on the models you're using. If you're using the cost model, assuming you're using the cost model, since the lecturer, I think, took this figure to the OCI. So if you're using the cost model, then you got the OCI. Okay, 600. But if you're using a fair value model, this gain here goes to the profit or loss. So I don't know which model we're using. Okay. And okay, let's take this. But I think fair value model is the most common one. So it's supposed to go to P&L. But since they are silent, I think anything you do will always be right. Okay. So ideally, you're saying you debit your asset with 600, hence you're increasing asset to this 2.2. And therefore, if I go to my statement of financial position under non-current assets, current assets, the investment property, say I had 1,680,000, added the 600,000. Okay, since I have a working, let me just say working 7. Working 7. Then you bring the final figure, which you got, which is this. Kindly mute. Okay. Then the credit, we said you go to OCI, okay, other comprehensive income, which is this side. Then you say, then you add the figure here. You should have some figures. 600,000. Okay. But another day, like I said, if it was fair value model, it goes under other incomes. Okay. Fair value gain, then you put 600 here. So assuming it's evaluation, however, since most of the questions, whenever there's evaluation in investment, it takes it to the OCI. So let's assume it's the other model, not fair value model. Okay. So that is it. Okay. Double entry, very important. Let's see now the final thing. Salaries are to be apportioned equally to sales, admin, and distribution. So salaries, the first thing is, you know, how much are salaries. Then come and look for them in trial balance. When you check, they're here, salaries, 900, yes, 900,000 salaries. Okay, so you go to your working of expenses. Okay, here, here, cost of sales, admin, and distribution. They said salaries. Remember the 900, and they're supposed to be shared equally. So if it's shared equally, there are 3. So 900 divided by 3, you get 300. So meaning that everyone will get 300. 300,000. 300,000. 300,000. Realize that I've not taken, I don't have debit other balances for these figures. Okay, no entries for these figures. Reason being that they were in a trial balance. So figures in trial balance do not have debit and credits. They only have a single entry. So and they were debits, so they come under expenses and they're positive. So officially you're done with the additional information. Then what happens is now you got the trial balance and you move line by line. Whatever you didn't touch, you touch. Okay, so we start from office expenses, office rent. So office rent goes under admin. Okay. So you come and say office expenses, office rent. So allow me pass these figures, what you're seeing, and I'll show you to you later. Okay, you'll see them later. So okay. Okay. So moment. So rent, I'm saying they go under admin. Reason being, as long as they don't affect sales and cost of sales, it can only be under admin. Hence rent, it is 588,000. The next consultancy fees still is under admin. So realize that these ones I'm just putting them just straight once. The reason being they're not entries. They've been around. Then salaries you've seen. Recoverable debts. Recoverable debts now they come under distribution. Reason being that I sold to you goods on credit, but I've not been able to recover the money. Okay. Someone else would say, I think they're under admin. Reason being they didn't do their job. Yeah, you may be right, but I think sales is more correct because the sales guys didn't do their job. Something like that. Okay, well, that feels more admin that someone failed to do his job, so it's supposed to be an admin. Okay, but since it's relating to sales, and sales is all about distribution, then it can only be under distribution. Okay. So, but of course, you get familiar with these when you do more numbers. You'll be able to easily know that this one goes here, this one goes here. Then general admin, this one I think is obvious because they say the word admin. How much? 750. Okay, then you have general distribution. Still, this one is obvious because they say distribution. So it goes under distribution. Okay. General. Then you have distribution center. Still, this is obvious. Say the word distribution, so it should go under distribution. 660. Then advertising, still advertising is obvious. Cost involves increasing sales, which is distribution to 40. Then you have equity. So with equity, we know that one goes under statement of changes in equity. So you go to statement of changes in equity. Statement of changes in equity. Okay. Then and draw the schedule. So you have details. Then you have ordinary shares. I'll share with you the answer in short. Then you have share premium. Then you have revaluation reserve. So you have reserve. Then you have retained earnings. So it's always obvious. Retained earnings. So the balances in balance come straight. This is cost. It's not cost, but balance go down. Or the opening balance. Ordinary shares have 1,620. So 620. Then share premium is 48. Actually 480. Then reserves or reversion reserve, you have 120. Then dividends. So dividends, we all know they reduce retained earnings, so they're still under statement of changes in equity. And you say dividend under details. Okay, can be declared or paid, something they all come under here. The debit balance, so when they're coming under equity, they come as the minus. 120,000. Then you have cash and cash equivalents. So that one is under current assets. So you go under statement of financial position. Under current assets and say cash equivalent. You didn't have an adjustment, so you just put the final figure. It is 18,000. Then receivables, still receivables is under. It is under current assets. It didn't have an adjustment, at least I didn't see an adjustment. So it is 138,123. Then you have non-current assets investment, that one we saw, and we dealt with it. Interest paid. Okay, could facilitation be interest? I've got facilitation under expenses. Let me go. Let's go and see. Okay, this one I have to share. Since they're saying, okay, sure. Since I think facilitation is actually an interest, so allow me kindly remove this. When we put it under expenses, if you remember, under cost of sales, we said facilitation fee. Yeah, put it under distribution, but I don't think it belongs here. It's actually an interest, since the question says interest paid, not to. Okay, so not to was facilitation. So allow me to remove this. Let's delete here. Then take it under interest. Okay, 122. So it's under profit or loss, interest. There's interest paid, but there was this figure here that we had as facilitation. Okay, so interest paid was how much? Let me see the question. Interest paid is 150. 150,000. Okay. So we are moving well, I think. Then I'll get back to the question again. Dividend received. Dividend received, you know that those are incomes. So you go under your P&L. Okay, profit and loss. Under other incomes, then you say incomes. Then you say dividend received. Dividend received. Okay, 10 minutes left on the link. So I may not finish. I intend to have this as the last discussion on this. So let me share the worksheet, my worksheet. Okay, so dividend received, where dividend received, they are 90,000. So under other incomes, okay, so 90,000. Then interest received still is under income 6,000. Received. So I think you finish the other parts in the trial balance, whatever I've left out behind, purchases, what, bank loan, okay, opening inventory, you'll do that. Okay, for now, let me take any questions if there are anything to ask. Do dividend received and paid reduce retained earnings? No, it's only dividends paid or dividends declared that reduce retained earnings. Okay, Then received, like you can hear the thing is you received. So it can only be income. So then received fall under incomes, other incomes. They actually increase, okay, the profit. Okay, of course, we know that at the end of the day, the profits that we get from here, we take them to retain the earnings. Okay, however, we take them there after passing through the profit or loss. Unlike dividends paid, for them, we take them under retained earnings straight. And the expenses. So I hope I've answered you clever. Okay. So any other question? Because if you don't have any questions, I don't intend to exceed here. So otherwise, you're supposed to have your revenues, total figure. Then cost of sales will come here. So let's cost of sales. Okay. This is working 2 or working 3. Working 3. The figure you get under cost of sales here. Working 3. This working 3. Expense allocation. This figure here, when you add, assuming you had all the figures, when you add, okay, this total figure here is what you take under the profit or loss here. Okay, then you add other incomes to get, okay, of course you have gross profit. So for purposes of time, I'm not really going to do the whole thing, but you know the format. Dividend received is an entry in the P&L, yes, and oh, it's in the P&L. Dividend received, it's an income. Okay. Then what else? Okay. So if there are no questions, we have 6 minutes left on the link. So if you have any questions, please, you can raise them now. Otherwise, I intend to stop here. Okay. Maybe before I stop. Now, after computing, I was still showing you the format. So I was saying after let's say in cost of sales, you have gross profit. After gross profit, then you add other incomes. Gross profit. Okay. Then after the other incomes, then you get gross income. Then you bring your other expenses or operating expenses. Okay. And operating expenses, they were split into distribution and admin. So you bring your admin and you bring your distribution. Okay. Please, you ask your questions as because I'm giving emphasis to your questions. I'll be responding to your questions. Here, I'm just doing it to just spend all the time. Okay. Then you have profit before interest and tax. Okay, so the figure you get.
Excuse me. Yes. Excuse me. Why are you adding the net realizable value like to the cost in the cost of sales column?
Net realizable value. Beg your pardon?
Like the 600. The 600 in the question, 600 million. Why are you adding it to the cost of inventory as a first number?
600 million. And the cost of sales. What's in 600 million? Kindly ask a question again using the items themselves, not the money.
Like the previous where you were scrolling, I saw cost of sales had included the 600, the net realizable value.
Net realizable value. You mean here?
Yeah, that inventory one. The one I'm seeing, yeah, under inventory.
Here.
Yes.
Yeah, you choose the smallest. We took 500. It was the smaller of the two. 500 is the value of inventory. So the only thing we're using 500. There's no 600.
Okay.
So back to this. Profit for interest and tax. Then you put interest. Then you get profit for tax. Okay. Then you deduct the tax, then you get the profit for the year or after tax. Okay, then profit after tax, you add these other incomes. Okay, add other incomes, and then you get total comprehensive income. Then your profit for the year, this profit here, goes to your changes in equity. Okay, so the figure here comes to changes in equity under retained earnings. So you come and you say total comprehensive income. Comprehensive income. Okay. The profit for the year comes under retained earnings. Then the gain on revaluation, what you call other comprehensive incomes, goes under revaluation reserve. Okay. Let me get this figure so that for clarity. This is 8905. Okay, this figure here, you bring it here. Okay, and you're done with the profit and loss. Then you come to changes in equity. We didn't have any other transaction really, so you add these. Okay, you add these. Unfortunately, we didn't have. I don't have figures. Okay, where have I put this? This one's supposed to be here. Okay. Okay, then you add the earnings also, whatever you get. Then these balances in the changes in equity, they go to the balance sheet under equity. Yeah. Okay, so equity and liabilities. Then you say equity alone. Then you say ordinary shares. Okay. Say share premium. Say retained earnings, valuation reserve. Those balances come in, the ones of changes in equity. Okay. Then after your assets, non-current assets, we still have a PPE schedule. So you say PPE working for the total figure, you bring it here for all purposes of time. Then you add together all these to get total assets. And that is it. Then you add equity with the liabilities to get total equity and liabilities. The figure should be able to balance. If you followed the eventually liquidity, it's going to balance. So otherwise, guys, thank you. I intend to stop here.